Good afternoon to all of our CLA family members, clients, and friends. This afternoon is a special Monday installation of our live stream series, and we just wanted to start out by saying first and foremost that your health and safety of you and your family and friends is our top priority. We also wanted to pause and give a moment of gratitude to all of you lenders who are joining us today, as we know you guys have been working tirelessly on interpreting all of the SBA guidance that we've been provided over the last week, as well as working with all of the small businesses to help get the much needed funding into their hands. We know that small businesses are the engine and the energy behind the economy, and we truly appreciate you doing your part to help support these businesses in this time of need. Last week, we spent some time with Jack Rubicki and Todd Sprang going over the PPP program, Paycheck Protection Program, as part of the CARES Act. And at that time, we really only had guidance from the CARES Act, but that left quite a few holes with how we defined several portions of that act and also how we actually executed on the lending. What we hope to do today is to really help to unpack various pieces of that, having gone through a full week of execution, and help you understand what you need to know sitting in the shoes of the lender. So today, what I'd like to do is introduce Charlie Cameron. Charlie is the managing principal of our financial institution group, and we've also brought Todd Sprang, who was on our live stream last Tuesday, back to join the discussion as well. So welcome, gentlemen. We're thrilled to have you today.
Thanks, Leslie.
Thank you.
So what we'd like to do is first, Todd, last week you gave us an awesome overview of what your expectations were with the PPP. Now, we all know that sometimes expectation and reality can be pretty far apart. So we'd like you to maybe give us some quick updates, including Charlie, about what actually unfolded as we started to get guidance and roll out the program.
Yep, sure, I can start that off, Leslie, thanks. I anticipated three things last week during our live stream. First, strong demand. Well, we certainly got that. I expected the borrower demand to exceed that $349 billion of funding that the program provides, and that still exists, and it's stronger than I think we thought even, and has come faster than we thought. I also anticipated the program could extend. That I'm reeling back on a little bit, because as I look at how fast this has progressed and how things have evolved, they've gone a little faster than I thought. While that's still a possibility, I don't know about that likelihood as much right now after the week has passed. Second, I was talking about the fact that lenders were ramping up and awaiting additional guidance from SBA, and I expected that guidance to come in stages. So that initial guidance came out from the SBA on Thursday in the form of an interim final rule, and since then we've seen a steady stream of additional guidance, and I expect that to continue as time evolves. And then third and finally, I talked about infrastructure. Now, frankly, I expected that to be an issue on the first day of the applications. I expected that pent-up demand to hit on at the initial stages of the application process on Friday morning. Now, that didn't come to fruition like I thought it might. We saw that some lenders paused and started, some started right in the morning, some paused and started in the afternoon, some even deferred till today. So I think that alleviated some of the infrastructure and software issues that we might have expected. And then I'll turn it to Charlie for some additional thoughts, because I know that that he saw some things firsthand in the field this week.
Awesome.
Yeah, thanks, Todd. So the majority of lenders are accepting applications, even if they aren't yet filing the applications, and they're very involved in understanding the program guidelines. With the start of the program last Friday, the SBA reported that they processed more than 17,000 loans, totaling $5.4 billion. Unfortunately, however, many lenders have not been able to gain access to the SBA's e-trans system for submitting applications. And we know there's been a process put in place for those additional lenders to apply to get access to the system, but we still don't have certainty around the timing of when that issue will be fully resolved. So for reasons related to the system access issues, but also issues related to just understanding the guidance relative to the calculation of the maximum loanable amount, the payroll costs. Because of some lack of clarity in that issue as well, I think it's fair to say that there's been a little bit of frustration among many lenders regarding the rollout of the program at this point.
Yeah, I think frustration, we can all agree, is probably an understatement. And I know everybody's been flying blind as we're getting all of this guidance all at once. There's a lot of people who want things very quickly. So we've received a lot of feedback on both, I think, the lender side and the borrower side. But, I think another thing that we've been hearing is that perhaps some financial institutions are choosing not to participate in the program. And maybe the two of you can comment on that as well.
Sure, Leslie, I'll start off on that. There is a group of institutions that I think for multiple reasons have been slower to commit to the program. And that's because I think they had some concerns. Those concerns might be around the program mechanics, the liability associated with the program, some uncertainty regarding the relations with the SBA, and maybe just availability of internal resources. And I think some of those institutions are taking the right attitude, and they've been attempting to refer borrowers to other correspondent lenders or financial institutions. But unfortunately, that may not work, as I'm aware that certain lenders are choosing only to work with, take applications from current customers at this time. And I know there are various reasons for that. But Charlie, I know you have some thoughts too on why institutions should be looking for a way to get their borrowers into programs such as the PPP.
Yeah, thanks, Todd. I would just add that in our discussions with our lending clients, it's clear that their participation in this program is not motivated by the SBA processing fees that they receive on a transaction basis. Rather, they're motivated because they want to support the local businesses and the broader communities in which they operate. And then I think an additional point to make is they recognize in this COVID crisis that they are dealing with an elevated amount of risk within their commercial portfolio. Now, none of us at this point can fully understand what that risk might look like. Not the accountants, not the bankers, not the regulators, etc. But I think supporting borrowers in obtaining this working capital grant, and the intention of this program is for these loans to largely result in grants, certainly is a motivating factor for lending institutions to participate, and it should be for them to participate in the PPP. So we're advising our lending institution clients with a commercial portfolio that whether or not you're directly participating in the program in terms of submitting applications, we certainly urge you to work with your commercial borrowers to help them take advantage of this opportunity to obtain additional working capital funds.
I think you raise a really great point, and that is, for all of these lenders to be looking at how can they be serving and helping their clients so that these businesses can continue to remain healthy and thrive and continue to be good clients for them. And so I think those are really good lenses to look at this with. Now, I know this guidance has been really fast moving. So a little over a week ago, we get the CARES Act. Thursday night, we get interim final guidance, which is in and of itself a bit of an oxymoron. And I know what we were all doing Thursday night. And then Friday night, we also get some more guidance on affiliation rules. So if you guys thought about all of these key clarifications that we've been starting to get from that guidance, what do you guys think are some of the most important things that we've seen?
Sure, Leslie, I'll start off with a few of those, just a few of those provisions. One is the hold harmless provision. And that's the lender does not need to conduct any verification if the borrower submits documentation supporting its request for that loan forgiveness and attests that it has accurately verified the payments for eligible costs. So in those cases, the administrator will hold harmless any lender that relies on such borrower documents and attestations. Also, I think another key component was the exclusion of compensation to independent contractors from payroll costs. Since independent contractors have the ability to separately apply for PPP loans themselves, the interim final rule does not count independent contractors as employees for purposes of determining that borrower's qualifying loan amount. And then the last point I'll touch on is when you look at the filing dates for reports on expected forgiveness, they're not going to be any earlier than 7 weeks after loan origination. So a lender can request that the SBA purchase the expected forgiveness amount of that loan that's in the program or pool of loans from the program at the end of a 7 week, at end of week 7 of the covered period. So the expected forgiveness amount is that amount of the principal the lender reasonably expects the borrower to expend for payroll costs, covered mortgage interest, covered rent, and other utility payments during the 8-week period.
Charlie, any other thoughts you can add to that?
Yeah, I think on the last point that Todd made, given that the lenders are delayed at least 7 weeks to submit the report on expected forgiveness, and then the SBA has another 15 days to act on that, I think we're really, by the time all the documentation gets put together, I think we're probably looking about a 10-week period before that expected forgiveness piece is going to get repurchased from the lenders by the SBA. The other item that I just wanted to add that we've now gotten clarification after several days of uncertainty, we know now that both banks and credit unions are not eligible for the program.
Great. So those are really, I think, important points. Now, as you guys have really gotten involved and you've seen the progression, we've talked about expectations versus reality. I think Todd mentioned, Charlie, that you actually had some firsthand experience this past week on Friday. So why don't you maybe just give us some insights to what you saw as you were in the field?
Yeah, thanks, Leslie. It has been interesting to sort of be on the front line of this. So what are we learning? Overall, I'd say, number one, we've learned that there are applications that are being completed by the borrowers that reflect a wide range of calculation methods for determining the loanable amount, which, of course, is based on the payroll costs. So we're assisting financial institutions in reviewing those applications and supporting documentation really to help them with their required process for doing a reasonable review of the borrower calculated loanable amount. And, based on those reviews that we've completed at this point, I would say in short that what appeared to be originally a pretty simple calculation of the loanable amount clearly has turned into something more complicated because for some of these borrowers, it includes a number of key issues that at this point remain unresolved by the Treasury and the SBA.
I mean, I think that's right. Every time we draft regulations or we write statute, we always think and anticipate that we've covered everything, but it really is when we start to put it in practice with companies and clients that all these other issues start to come out of the woodwork, right?
Right. So, for most of these institutions, we're working with them and have been working with them really on the front end of this. So we've worked with them in terms of the information that needed to get accumulated from the borrowers, as well as the application itself. So, what we're trying to do, again, is to assist in terms of that responsibility. We're trying to facilitate it as best we can to make it seamless for our clients in terms of reviewing those calculations of the loanable amounts. I would tell you that what we're seeing is a wide range of submissions from the borrowers. We see some applications which are fully complete. We see others that may have as little information as just the name of the borrower at the top. But again, our goal is to work in sort of a seamless manner with our clients to, number one, identify if there's any missing information that we need from the borrower. But then once we get all that information, more importantly, to share with the lending institution if there are any potential discrepancies in terms of how the borrower has calculated the loanable amount. And if so, we not only communicate the dollar amount of that discrepancy, but essentially the root cause behind the calculations of the discrepancy, so that the lenders can fulfill their responsibility then in working with the borrowers to resolve those discrepancies in a timely manner.
And
That
Charlie,
makes sense.
as you mentioned that, sorry, it's like there are CLA's team members standing ready to assist with more of those services. If there are lenders out there that think that they have some needs, right? We've got some folks that can help them with overflow or other needs, right?
Yes, absolutely. We have those resources and are able to ramp up. Of course, again, we've been involved in a number of institutions already, so we're at the early stage of execution experience, but definitely have additional resources to help with excess volume, what could be some complicated issues with borrowers. Certainly, those situations we're open to assistance as well.
That's great. And Todd, you know, in addition to Charlie being in the field and getting some good insights, you have been helping people all across the firm, both on the borrower and the lender side on that. And so, you know, I think you have a really good understanding of the common issues we're seeing. And if you were sitting in the shoes of a lender, you know, where would you recommend that they start their assessment of an application?
Yeah, Leslie, you're right. In working with our team members at CLA who have done a wonderful job of responding to questions and gathering questions, you do see some trends. And I did put myself in the shoes of a lender and thought, from a risk management standpoint, how would I take on this application process? And so I've identified certain components of the application that I think would either prevent or delay the SBA from performing on their guarantee. In short, situations where the SBA can state that the institution never should have made the loan, because I think those are the first areas to focus on and the key areas. Examples of those are limited, examples of those are things like looking at the entity ineligibility, you know, based on organization structure. If that organization structure isn't right, you don't go much further in the application from my perspective. Also, if they exceed that 500 employee threshold. And I would say even from a risk management standpoint, again, if you're near that threshold, like 490, 495, I think then you need to take a better look or a deeper look at those at that head count. And then fraud. And I can talk more about that later, but you've just got instances where we know there's going to be attempts to fraudulently get money out of this system, and the institutions have to protect themselves. So this high level assessment is easier for a current customer than a new customer. And I don't think most applicants understand that. Mm-hmm. And so let me start how I would to identify how I would put those applications into maybe groups or buckets to
That'd
analyze.
Be great.
So first, as I said, customers versus non-customers. Customers are known to you. You know the information. You're probably familiar with them. Versus non-customers that you may have to get a little more comfortable with their structure and some of those other questions. I put the eligibility question first because I'm trying to evaluate applications as efficiently as I can. And so I don't want to dive deep into that payroll calculation and spend a good deal of time there if I'm dealing with an applicant that doesn't meet the requirements. So as I said, someone here who's near the threshold, someone who, you know, do I have to consider revenue and net worth caps? I mean, there have been entities that in the past have not been eligible for SBA funding because of certain revenue and caps, and do I have to analyze that? And then also, do I have complex affiliate relationships to assess? Mm-hmm. And so then I'll say the next bucket also, and where I might make a distinction, is not-for-profits. Because they have been previously excluded from these type of loans, and they have certain I'll say special considerations when you think about the interaction of the grant funds that might reimburse their payroll costs and how you incorporate that into an eligibility calc under this program. And then there might be tribal entities or other small businesses, as I referred to, that might normally not be eligible for SBA loans, but are eligible for this program. So whether I'm an experienced lender or new lender, I have to do some additional analysis and take those into account. So after considerations such as this, then I move to the second stage with is the payroll-based calculation part of the application.
So I think that's great. I mean, I like how you did a very practical approach, and that's, let's start with eligibility. Now, if I'm eligible, I've got to go to, did this loan get sized correctly, which all hinges on this definition of payroll, which is a lot hairier than I think everybody thought. So maybe Charlie and Todd, you guys can talk a little bit about what types of discrepancies or considerations we're seeing as we define truly what payroll costs are here.
Yeah, Leslie, that has been the big issue that lending institutions, accountants, attorneys, and so forth have all been struggling with. So I'm just going to briefly talk about some of those issues and perhaps some different interpretations of the law and the interim final rule, along with some additional guidance. The SBA came out recently with an FAQ that addressed some of these issues. So first, there is an exclusion for compensation costs for employees that have an annual salary in excess of $100,000. So that is open to some different interpretations. So the simplest interpretation is that we just look at salary. So if an employee has salary in excess of $100,000, any salary amount above that $100,000 threshold gets excluded from payroll costs. And we don't touch benefits. We leave benefits in the calculation of payroll costs. And I would just briefly add, the FAQ issued by the SBA seems to provide some additional support for that position. And again, it's that position that will result in the highest loanable amount. The second interpretation, sort of the polar opposite. It says when you look at the 100,000 threshold, you would include everything, not just salaries and wages, but also all benefits. So you could have a person that has a salary of $95,000, but they may have benefits equal to an additional $15,000. So they have total comp of 110. That's above the 100,000 threshold. So we would exclude 10,000 of cost from the payroll calculation. And then the third is a little bit of in between. And that's just to say you would only look at those employees for exclusion purposes that have in excess of $100,000 of salary. But if they do have that threshold, then you would include both salary and benefits in excess of that amount. So a little confusing. And again, we've seen, I think they're all reasonable interpretations at this point, and we've seen all three methods applied.
Yeah, and that's what I've even been telling people as we've been helping on the borrower side is we've all got to do the best we can and interpret the guidance that we've got, and it may morph and it may change because we're all learning together. Todd, what else do you think about this issue?
Yeah, I think there's a lot of questions and a lot of confusion. I think on both sides, the borrowers and the lenders are both struggling with some of the same issues. The one that I referred to before, I think, was one of them. Do certain revenue and net worth caps apply for small businesses? And I'd just say entities that previously couldn't get SBA loans but now are eligible under this program. It makes it difficult to really adjust on the fly and take the considerations of those entities into account.
Sure. So another hot button, I think, is, how do we define self-employment income in all of this? And Charlie, since you've been in the trenches, why don't you tell us all the different things you're hearing and seeing?
Yeah, thanks, Leslie. So we're back to that payroll cost calculation. And again, this is an area where we've seen multiple interpretations. So for owners of partnerships and LLCs, we see some of them, and it's very common for owners to take cash distributions of profits during the year. So they're taking the position that is similar to salary, and it's within the spirit of this act. So they're including up to $100,000, those owner distributions throughout the year. Now, again, the FAQ did address this, but the guidance still kind of fell a little bit short, because while they said that they did not think including these owner distributions was within the spirit of the Congress's intent, they also made a reference that it would only be appropriate to include such amounts that are subject to self-employment income. So probably in a lot of cases, the fact is that there will be enough self-employment income in that year for some of these owners to cover up to $100,000 or even some lower amount of the distribution. So one could still argue that they are includable. And, on the owners of partnerships and LLCs, the other common approach that we've seen is just to include guaranteed income in the payroll computation. And of course, if you do either one, whether you go the cash distribution route or you take the position of guaranteed payments, you then are going to be including those owners in the employee count for eligibility. So we see yet a third bucket where certain professional service firms are not including any of those owner amounts because potentially including the count of the owners in the eligibility head count would potentially disqualify them.
Those are great insights, and you guys have unpacked a lot of information in a short amount of time, and I know there's going to be a lot more that we start to discover, and you guys are going to do a great job getting that information out to the market. So, what I'd love to know as we wrap up today's session from each of you is just one more thing that you think lenders should be considering as they're working through this process.
Yeah, well, maybe Leslie, I'll start and I'll talk about just one of the common questions that I get that the lenders are struggling is with just how do I get my borrowers into the right programs? How do I handle a mix of modifications and programs in this environment? Do what's best for my borrower and do what's best for me. Charlie, your thoughts?
Well, I was just going to go back to a little bit of the frustration, Leslie, around the access. And we really are dealing with three different groups. The folks that have been in the SBA's preferred lending program have had generally continuous access to the SBA system. So they've been able to file applications. Then we've had some folks that have at some historic point had access. And the SBA's put together a protocol for them to essentially renew their access. And we've seen folks successful in getting that done. And then the other bucket, there is a lender agreement form that has to be completed and submitted. But we're seeing a little bit of frustration because there's a second form, an incumbency certificate, which must accompany that lender agreement. And that form, frankly, has not been real accessible to a lot of institutions. So we've attained that. If anybody needs that, certainly feel free to reach out to any of your CLA contacts and we can get you that form.
Well, I just want to thank both of you so much for your expertise, for really helping us navigate this. And I wanted to thank everyone for joining us today. We know this is a hot topic, and so we have 2 additional live streams on Tuesday and Thursday at their normally scheduled time this week. And we're really going to focus this week on really continuing to discuss what are those key developments that are coming out related to the PPP and how do they apply to the borrowers and the lenders. So we encourage you to join those, continue to be part of that conversation with us. If you have follow-up questions from today's session, you've got a couple options. One is certainly reach out to your CLA contact, get in touch with them and start a dialogue with them. Also, if you don't have one of those people, feel free to use the app on the description box below. And until then, we are wishing all of you a safe and healthy week and have a wonderful rest of the day. Thank you.